On October 15, 2008, the Board of Directors of Ensor Materials Corporation approved a stock option plan for key executives. On January 1, 2009, 20 million stock options were granted, exercisable for 20 million shares of Ensor's $1 par common stock. The options are exercisable between January 1, 2012 and December 31, 2014 at 80% of the quoted market price on January 1, 2009, which was $15. The fair value of the 20 million options, estimated by an appropriate option pricing model, is $6 per option. 2 million options were forfeited when an executive resigned in 2010. The other options were exercised on July 12, 2013, when the stock's price jumped unexpectedly to $19 per share. Alright, the first requirement says determine the compensation expense for the stock option plan in 2009, and we're to ignore taxes. Alright, let me show you the calculation we'd need to make there. Alright, we need to take the $6 estimated fair value per option. I'm reading right here, this line. Then to the left of my mouse, times the 20 million shares, the 20 million option shares granted, right? Or the 20 million options granted. And so we come up with 120 million is the fair value of the award. Now the total compensation is to be allocated to expense over a 3-year vesting period between 2009 and 2011. So we take the 120 million, divide it by 3 years, and we have 40 million per year. And so the solution would just simply be the $40 million. Alright, number 2 says, what's the effect of forfeiture of the stock option on Ensor's financial statements for 2010 and 2011? Okay, now right in this area of the screen you can see where I've illustrated how we would calculate how to answer that second requirement. So Ensor should adjust the cumulative amount of compensation expense recorded to date in the year the estimate changes. So in 2010, the compensation expense would have been 120 times 90% times 2/3, right? Minus the 40 million that was already recorded. So that comes up to be 32 million. In 2011, we have 120 times 90% times the full 3/3 minus the 40 million that was recorded. So that would be 36 million. So to slide up, the entries we would make then would be, let me see if I can get this on the screen a little bit better for you, is 32 million debit to compensation expense for 2010, a credit to paid-in capital stock options, and then also in 2011, compensation expense of 36 million debit and paid-in capital on stock options of 36 million. All right, let's slide back up now and read number 3. How should Ensor account for the exercise of the option in 2013? So we're reading just to the left of my mouse there. Okay, now I've adjusted the screen so you can see the calculation on how we would answer that. Requirement 3 would be a debit to cash equal to 15 million times 80%, or $15 times 80% is the $12 exercise price times 18 million shares, so 216 million is debited. The paid-in capital on stock options is equal to 108, the account balance of the 108 million. The common stock goes on the books at the 20 million less the 2 million, or 18 million is the legal capital amount, and the paid-in capital excess of par is 306 million. So that gives us enough information to put this together, and realize that the market price at the exercise is irrelevant, and then we see that requirement too then illustrated with the journal entry down below.